The idea behind sleuth investing is to go beyond reading some of the easily available materials. So, of course, we should all be reading the annual reports of the companies and of their competitors, and also looking at the earnings calls and presentations and so on. That type of material is widely available, and I think it's important to make sure you've read and understood that. So it's not about replacing that. What it's
Mm-hmm.
about is going beyond and becoming a bit of an investigative journalist and trying to really deeply understand a company or an industry. And you can imagine, I think, an important principle in value investing is that a stock is an ownership share of a business. It's not just a number going up and down on a screen. And so if you were to own a business, you would probably do more than just look at some of the annual reports of them and competitors. You would probably want to talk to the real people in the industry, talk to competitors, talk to people with experience either at that company or at similar companies, and just try and much more deeply understand this business. What are the economics? What are the key drivers? What are the competitive advantages, if any? And just really do that much more in depth. And so you're effectively like an investigative journalist, actually attending things in person rather than just being sat behind a screen reading reports, which is important, but I think this is sort of taking it a step further.
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question, what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable quality businesses while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on the show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. My guest today is Chris Waller. He's a seasoned investor, the founder of Plural Investing. He's known for his disciplined approach to small cap value investing, where he identifies hidden gems through meticulous research and a keen focus on governance and management integrity. Chris, how are you? So nice to see you again.
I'm good, thank you. Thank you for having me on today. Looking forward to it.
I got to meet you and listen to you speak at the Clusters Value X that's hosted by our mutual friend, Guy Spear. I'm not going to ask you about the stock you presented, but I want to say that you made an impression on many of us, and I wanted to have this conversation with you because I feel like you go about research and investing in a way that's different, and I think more people could learn from the kind of work that you do. I want to ask you about the early days, and I know nothing, so I'm very curious. Childhood, upbringing, how do you think that time shaped you, your relationship with money, and the career path that you chose?
Yeah, well, thank you for those kind words. Yeah, I had an interesting upbringing in a couple different places, really. So I was born in Hong Kong. My mother's side of the family is from Hong Kong, and my father's side is from the UK. And my dad was a journalist and an editor, mostly focused on financial news. And he moved to Hong Kong and he worked at different publications like the Asian Wall Street Journal and the Far Eastern Economic Review and Bloomberg. And so I lived in Hong Kong until I was about 12. And we moved over to the UK, to Bristol in the southwest of the UK, and I sort of grew up in the UK, really. So two quite different environments. And I think that gives you a broader perspective when you experience two different environments like that at a young age. I'm now based in the US. So I've been based in the US since 2016. So I have lived in three different areas, and I do think that's helpful, or it's interesting to have seen quite different perspectives. In terms of sort of relationship with money, I was lucky. I grew up in a middle class family, I guess. So I wasn't sort of struggling or anything like that growing up financially. And I got lucky that I first got interested in investing in September 2008, which is when I was 16 at the time. So that sort of dates me. I'm 32 now. In some ways, a great time to get started. It's obviously a very interesting period. I was taking my first classes in economics and so on, and there was a national investing competition in the UK called Student Investor, and my economics teacher put me forward for that. It was something I got hooked on very immediately. And I was also lucky that September 2008 was also when The Snowball about Warren Buffett was released. And so I was fortunate that sort of very quickly I was interested in value investing and so on. So that really shaped my experiences with money and how I got started in investing. So definitely an interesting time to begin.
And I think it shapes you, and I'll come back to it in a second, but I have very vivid memories. And I was already 3-4 years into my career in '08, working in New York City at an investment firm. And I remember going to a meeting, and I might have mentioned it in one of my books. It was a meeting with Tiffany, the company, no endorsement. I don't even know if they're still public. I don't think so. But it was at the top of a high rise, and it was a foggy day. And I went up, and I thought there would be a lot of people attending. It was just me and one more person having a tiny breakfast with the CFO and CEO of the company. And I was thinking, nobody's meeting companies. Everybody's panicking. And as a fundamental research-driven analyst and money manager, I thought there might be opportunities when nobody's coming to meetings with managements. And this was the best time to buy. It was early 2009. But it was pretty scary. And I haven't seen anything like it since. Some scary moments during COVID, some maybe scary moments the last few weeks, but nothing like that.
And I think it's good to have moments like that at the beginning of your career, because it does leave a lasting impression on you. And I do think that although there was a crisis during COVID, it was fairly short. It wasn't like 2000. And so I do think it's been 16, 17 years now since we last had a really sustained crisis like that. And so you do have a lot of investors today who haven't really experienced that. And, I'm lucky that I'm still fairly young, but I got that right at the beginning. So just in time, I guess, from my perspective.
You got your education. Yeah, I remember walking home one of those days. The market was down and everything was down. Some of those days, 08, 09. And I was thinking maybe it's the worst thing that could be happening. But I quickly changed my mind, and I realized I think this is the best thing that can be happening, because I'm at the beginning of the runway here, and this is the time to learn. I don't have a lot of capital at stake, and I'm still learning, and I think it will shape me in a certain way. I'll look over my shoulder more often and realize that it doesn't have to be all up and up. I want to ask you about the early influences. Columbia Business School, Joel Greenblatt. Can you introduce Greenblatt to the audience and how he influenced your thinking about investing?
Yeah, so Joel Greenblatt was a professor at Columbia Business School at the time I was there in 2016 to 18, and he is and was also a very successful investor in his own right, running Gotham Capital. I think it's public in his book that he delivered 50% returns per annum for 10 years, and then I think he returned outside capital and ran his own and his firm's money for another 10 years, quite successfully. He then wrote books on the magic formula and several books actually, and has taught at Columbia Business School for a long time. And I just got very lucky that I was in the value investing program, and I believe it might have actually been his final year as a professor, which I didn't know when I applied. So, 1 year later, and I would have missed out on those classes. And Joel is a value investor, and what he would say at the beginning of his classes is that if you do good valuation work, the market will agree with you. I just won't tell you when. And I think the principles that he teaches are timeless, and they still work well. And essentially what he did and what he teaches is to look for companies off the beaten track. They can be small caps, but they can also just be what he might call special situations. Spin-offs would be a classic example, but just companies in a situation where they aren't well covered, and if you're willing to do some extra work, you can uncover something that a lot of investors are not looking at in depth or focused on. So he wrote a great book on special situations, but I think that those principles can be applied more broadly. And so I think when I took his classes, one of the pieces of advice he would give me is that, if you look at small cap stocks, there tend to be more opportunities there because the investors who are sophisticated and looking at those tend to do well over time, and they raise capital as a result of that, and they can then no longer invest in some of these smaller companies. And so you have this kind of natural process where there should always be opportunities in the small cap space as well as other areas. I think another principle he talked about is be concentrated and focus on your best ideas. That with 7 or 8 stocks, you can get most of the benefits of diversification without some of the negatives of giving away better results because you're focusing on worse ideas. And maybe another principle or idea he talked about quite a lot was look at the incentives for the insiders or management at a company. So whether it's with spin-offs and which managers are moving to the company being spun off, how are they being compensated, are they taking a lot of that in stock, and so on. A lot of it, I think, is focused around the insiders and the incentives for them. So I'd say those are some principles that he talked about, which can be applied in different ways. And just one other thing that Joel founded, which I don't think gets enough credit, is Value Investors Club, which is a website where there are about 500 members, and it's only about 1 in 15 members that gets accepted. And the idea is you submit a write-up, and if it's good, you get accepted. And it's an anonymous write-up, so it's not based on where you work or who you are. It's just based entirely on the quality of your write-up. And the membership requirement is you submit 2 write-ups per year, and in return, you get to see all the other write-ups that everyone else is submitting. So that's something that he's founded. I think he launched it around 2000, and it's maybe the best sort of collection of financial history and investment history that I'm aware of. And one thing he talked about in his class as well is it's a bit of a gold mine for ideas, so use it.
I think it's a wonderful idea, and when I think of Greenblatt, I see a sort of marriage between looking for quality and not overpaying for it. And I think it's very important, at least to me, because a lot of people can point out great businesses, quality businesses, attractive businesses, but we forget the second side of the equation. How much are you going to pay for it? And his approach is very simple, the formula that you talked about, but he has done so much more that you mentioned. But that formula itself really spoke to me because I think it's as important to find the right businesses, but also not overpay for them. You talk about this concept of sleuth investing, not sleuth. Although sloth investing, I think there's some merit to it too. I had somebody on the show that talked about being a sloth. I think even Buffett says that best investing is sloth-like. What is sleuth investing? I'm thinking of a detective and a murder mystery story and looking up details with a magnifying glass. Am I onto something?
Yeah, I think the idea behind sleuth investing is to go beyond reading some of the easily available materials. So, of course, we should all be reading the annual reports of the companies and of their competitors, and also looking at the earnings calls and presentations and so on. That type of material is widely available, and I think it's important to make sure you've read and understood that. So it's not about replacing that. What it's about is going beyond and becoming a bit of an investigative journalist and trying to really deeply understand a company or an industry. And you can imagine, I think, an important principle in value investing is that a stock is an ownership share of a business. It's not just a number going up and down on a screen. And so if you were to own a business, you would probably do more than just look at some of the annual reports of them and competitors. You would probably want to talk to the real people in the industry, talk to competitors, talk to people with experience either at that company or at similar companies, and just try and much more deeply understand this business. What are the economics? What are the key drivers? What are the competitive advantages, if any? And just really do that much more in depth. And so you're effectively like an investigative journalist, and there's no specific rule as to how many people you need to speak to, or what specific events you have to attend, but just for my own purposes, I find it helpful to generally try to speak to sort of 10 to 20 people in this industry prior to making an investment. I find that number usually helps you understand the company. It can differ depending on how complicated the company is, but roughly speaking, that's the sort of number of people I would look to speak to. And then attending industry events on an ongoing basis, such as trade shows, actually attending things in person rather than just being sat behind a screen reading reports, which is important, but I think this is sort of taking it a step further.
As I'm listening to you, I'm thinking of Phil Fisher, Common Stocks and Common Profits. It's a book that I might have given.
Scuttlebutt would be another phrase that is similar.
But at the same time, I'm thinking, how many people are doing it these days? I manage money for families, long-term patient capital, multi-generational wealth. I hold stock portfolios for them. I know the businesses we own. But we're living in a world with a lot of passive investing. When you look down the list, you talked about ownership. And to me, what Peter Lynch told me in his book, that stocks are small pieces of businesses, it's one of the biggest revelations that I had early on. But when you look at ownership of some of those businesses, these are index funds that are anonymous in many ways, and the CEO, CFO doesn't even have anybody to talk to at those institutions. And they hold those stocks because they're in a certain index or not. Would you say that there are fewer people doing the work that you're trying to do and that I do, that actually look in, not beyond even the annual report, and actually ask people around, what do you think of this business as a competitor, as a customer, as a supplier?
Yeah, I think the number of people doing this type of work is fairly low, and that's because it's really time intensive. There's obviously a growing number of investors that are passive investors, like you mentioned, but even amongst active investors, if you're a fund manager and you own 50 stocks, it's not very practical to spend this amount of time on every single company, because sourcing this number of people is time consuming. Getting these interviews or meetings set up is time consuming. You have to sort of work with other people's schedules, and they don't necessarily just speak to you on the same day or even week. And so it's not very practical for an active investor, even that owns a lot of stocks. And so I think that one of the benefits of being concentrated, like we talked about, 7 or 8 stocks, that means you can actually spend this amount of time on each company. And so I think that's an advantage. The other thing is I think that the time horizon of a lot of investors has reduced, and this type of work that I'm talking about is quite qualitative, and it goes more into competitive advantages and so on, things that are going to make a difference over the long run. But if you're just looking at next quarter's earnings, they're going to typically have a lesser impact. And so I do think that from a time horizon point of view of that shortening, there's probably fewer people doing this type of work.
You know, I like to say that I'm probably not smarter or faster than anybody else, but I can definitely try to be more patient. And a lot of things that you talk about, they'll take time. And I think there are not only fewer people that are looking beyond the annual report, although I would argue there are a lot of people that don't even open an annual report, and there are even fewer people that can actually wait and sit and see what happens. I want to ask you about hidden gems. What are they? How do you find them? What are some of the metrics or the qualities of those hidden gems?
Yeah, I would just add something to your previous question, which is that the importance of waiting. I think that a lot of investors generate their ideas by looking at screens or reading a write-up, and that's the sort of beginning of their investment process. But I also think over time, you're effectively building a database of knowledge on different companies, and a company that maybe isn't attractively priced today could become so in a year or 5 or 10 years down the road. And so when it comes to sleuth investing and attending industry events, sometimes a lot of it is about building up that knowledge database and having the patience to wait, and knowing that you understand the industry, or you've shortcut your learning process now, and at a future date this might become interesting. So I think having that patience is an important part of it. Just in terms of hidden gems investing, it's a similar idea really to looking off the beaten path. And so there are some things that are common. Generally, these companies that are hidden, that are less well known, are going to be smaller businesses, smaller in terms of market cap or daily trading volume. Some of these companies have very little sell-side coverage, maybe even no sell-side coverage. But I think the essence behind it is companies that are not widely known. There's not lots of information easily available. Some of these companies may operate in an industry where the competitors are private, and so there are no other annual reports or earnings calls to assess this industry. Maybe there are even no industry reports. And so essentially you're looking at things where there's just very little easily accessible information. And so therefore, if you're willing to do this type of sleuthing, you should be able to understand the business and the industry better than other investors who aren't doing that type of work.
And once you find one, how can you tell that this is a hidden gem? What makes it a hidden gem?
Well, I guess there are some, financial metrics that a lot of investors are looking at, the return on capital, and I'm particularly focused on incremental returns on capital, not just what the business is currently doing. But I think that a lot of this comes down to doing the qualitative work that is going to help you figure out what the correct numbers really are. So the secret isn't necessarily in finding some new metrics that no one else has thought of. It's really in doing the qualitative work to understand, okay, this company really does have competitive advantages that's going to enable it to keep investing at these returns on capital, or these growth opportunities or reinvestment opportunities really exist because of all these different qualitative reasons that I've discovered. So, of course, I think with every investment, I'm looking at the incremental return on capital versus the multiple of free cash flow you're paying for that multiple. But a lot of the work is really about doing that qualitative research to figure out what are the right numbers here.
I like what I'm hearing, and I want to come back for a second to what you mentioned about what I call a wish list. And maybe it's a secret, maybe it's not a secret, but somebody that has been doing it for a while eventually has a list like I do of companies I'd like to own one day. And that list comes in handy when the market corrects. It's surprising, or not so surprising, how many of those stocks that you wanted to own at some point in time are available 20, 30, even 50% lower. So that's something to keep in mind. If you found something you like, as you said, you could wait a bit to get the price you want. I'm curious about your research process that led you to something surprising, something that you didn't expect. You found something through your work, and maybe you can pull up an older case study that's not a recommendation, but something that maybe you could show to this audience. How do you come about what you wearing the sleuth hat? How does it look?
So I can use a case study on a company called TerraVest Industries. It's not something that I currently own today, so it's not an investment recommendation, but I think it could be helpful as a case study. TerraVest is a company that at first glance does not look particularly interesting. At the time I invested in it, it was mostly in the storage tank business and also the cast iron boiler business, so not really interesting industries at first glance. It would provide these products primarily in the US and Canada. The company had a very strong track record from a numerical basis. The returns on capital were about 20% per annum after tax. Management owned a lot of stock. The multiple of free cash flow you were paying was high single digits. So there were a lot of quantitative metrics that suggested this seems like a reasonable company that's trading for a cheap price. But I think a lot of the work that I tried to do was trying to figure out, can this continue? And so TerraVest's success really came in acquiring small and niche suppliers of these products. And what I did is I tried to speak to the founders of some of the small companies that they had acquired. And so TerraVest is usually the biggest player in each niche market, and it acquires these mom and pops. And when I spoke to those founders, I tried to understand what changes did TerraVest make at your company after they acquired it. And what I realized is that TerraVest has a very big advantage because of scale. The biggest component of the cost of a storage tank, typically about half the cost, is steel. Mm-hmm. And TerraVest, because of its scale, could essentially acquire a mom and pop, start manufacturing the same product, but because of its scale, it could procure that steel for about 10 to 20% cheaper than what the previous company was able to do. And as you can imagine, that's a very meaningful cost saving on the same product. There were some other advantages that these founders told me that TerraVest was able to achieve. So you had similar procurement benefits on other parts. You had some shared resources in terms of factories consolidating. You also had a change in mindset because a lot of these founders, they had put their life's work into their business, and so they were quite risk averse. They were often actually not as focused on profits as TerraVest was. And so TerraVest could come in and essentially take that risk and raise prices in some cases, reduce the production of less profitable products in some cases, and just have a different mindset, much more focused on profitability. And so all this qualitative research suggested to me that this was a sustainable advantage that TerraVest had. In many of these industries, there was really not another natural acquirer than TerraVest, and that there were many of these niche industries because each size of storage tank typically had different companies producing them. And so there were a lot of niches for TerraVest to continue investing in. So going back to that point of this company generates 20% returns on capital, it wouldn't typically trade for, 8 or 9 times free cash flow. Can it keep generating 20% and compounding at that rate? I think the answer was yes, based on this research. And there were no industry reports on TerraVest. There are no publicly listed competitors. So the only way you could have really figured this out is by speaking to the people in the industry. And whilst no individual company the TerraVest acquired was that significant because they'd done about 20 acquisitions over 9 or 10 years, when you started speaking to these people, you realized that they were all sort of telling the same story. And that's how I was able to sort of piece this together.
It's a kind of idea that will not pop up in a screen. It's an idea that you have to go out and find it, or the idea finds you.
And I think a lot of that was partly why the stock was cheap, because a lot of people looked at this at face value and said, well, it's in storage tanks and all these kind of industries that don't seem very attractive, and really dismissed the company because of that. But actually the story that was going on here was much more interesting. You just had to dig a bit deeper.
Would you say that a lot of your hidden gems are ideas where the value gets realized and you move on to the next one? Or is it a situation where you have a true compounder when the value gets increased in some way continuously? You talked about returns and incremental returns. I'm thinking I know the answer, but I'm curious how you think about it.
Generally, what I'm looking for, I would not classify as cigar butts, and not just kind of traditional cigar butts in terms of a company trading below working capital or anything like that. But I'm not trying to look for companies where there's a re-rating in terms of its valuation and then I move on. Ideally, I'd like to invest in a company which does have that ability to keep reinvesting at those good returns. And if it does so, it should really continue compounding. And it's rare for a stock to fully price that in so quickly. In the case of TerraVest, it did actually price it in fairly quickly, but I think that's unusual. Generally speaking, these are businesses that you can own for many years.
I want to ask you about the management, and I know you pay a lot of attention. You touched on it briefly, but I want to really dive in. Management integrity, corporate governance, especially in the small cap space, is it different? And what are the telltales that you're looking at that matter to you and help you with the investment decision?
Yeah, I think corporate governance is really important, and I certainly underappreciated it when I got started in investing. And generally now for me, it's the first filter for any new idea. By corporate governance, I'm speaking about it more broadly in sort of 4 key areas. So one is the shareholder base. Number 2 is the actual board of directors. Number 3 is the executive management. And then number 4 is the employee base or the culture. And I would say that all 4 of those areas are part of what I would call corporate governance. And ideally, I would like all 4 to be aligned in shareholders' interests. And if you look at the shareholder base, for example, surprisingly not every shareholder base is actually interested in shareholder returns as their first priority, or they may have some other motivation. For example, there are some shipping companies out there where there is a separate general partner that gets paid a fee based on how many ships the company owns. And so the incentive for the shareholder in that case may be not only to generate profits at this company, but to actually own more ships so that its general partner generates more recurring fees. You may get some cases where there's a majority owner, maybe a family owner, that although they probably do care about what the value of the company does over the very long run, because they have no interest in selling the business for the next 5, 10, or even longer period of years, they really don't care about where the share price is going to be. And I think there's sort of a fine line between being long-term focused and actually just not being shareholder friendly. And you also get cases where there's sort of government involvement, even at the board level, as well as the shareholder base. And obviously the incentives of the government may be different to the incentives of the shareholders. On the board, unfortunately, I think it's quite common now for board members not to be that shareholder focused. Some of them don't own many shares. Many of them, if they do own shares, they didn't pay for it with their own cash, which I think is very different when you buy something with your own cash. A lot of their incentives may be just to maintain the status quo. and they may be on quite a number of boards, which I think is a telltale sign. Executive management, I think is probably something that people talk about a lot more in terms of their incentives. And then just the shareholder, the employee base and the culture of the firm, I think is really important to, again, ensure that all parts of the company are moving in the same direction in shareholders' interests.
To me, in general, listening to you, I'm thinking that what is it that I want and what is it that I don't want? And it's sometimes easier to say what I don't want. And I came across some individuals running businesses that I just don't want to be partners with. It's an easy decision sometimes, no matter what the numbers are and how good of a business is.
I agree with that. I think that a mistake probably many investors, including myself, have made at times is to try and justify a member of management or CEO of low integrity or where the incentives aren't aligned. And you see that at all market cap levels, but certainly in the small cap level, there are promotional management teams, and usually it's fairly obvious. Actually, there are different things you can do to try and understand someone's integrity in terms of reference checks or looking at their actions in the past, or little changes around compensation when targets aren't hit. They given the compensation anyway, and so there's different things you can do, but generally speaking, that the people of low integrity are fairly obvious once you do some of the work. And I think just a behavioral bias a lot of us have is probably looking at a situation where there's a big promise of high returns and trying to justify to ourselves or turn a blind eye to some of these kind of low integrity moves. And so I think there's really no price that's worth paying to partner with someone like.
It's a lofty goal, but I'm looking for something that's almost not for sale. I'm looking for somebody who will do the right thing, even if nobody's watching. Yeah. And when you find people like that involved with a business, you found something really special. And it's not always visible. It's probably not visible at all in the financial statements. Maybe there are hints of it. You actually have to go in and do the work that you do to realize what kind of quality of people you're dealing with. And Munger and Buffett talked a lot about it, how they would have those one-page agreements with people where they knew the handshake meant something, and they knew who they're dealing with. And maybe it's a great reminder in today's world of finding the right companies with the right managements, because they matter, they make a difference. Chris, I want to ask you about portfolio management. You find ideas that you like, and I think it's a topic that probably doesn't get enough attention. I'm always fascinated how people think about it. And I have friends that have 4 stocks, and I have friends that have 100 stocks, and I'm somewhere probably in the middle, closer to fewer stocks rather than too many. But how do you think about position sizing and then mitigating some of the risk? Because I like to say that I want to be the least wrong, but I could be wrong. And if I'm wrong, how much pain am I going to endure?
Yes. I think position sizing is all about risk management, and risk, as you say, it's not about what happens if you're right. It's what happens if you're wrong. And I think that's actually a very difficult concept for everyone to accept, that they could be wrong. And what does the world look like if you're wrong?
Mm-hmm.
So I see risk not as the stock declining necessarily, but what is a loss over a 3-year period? My idea is what is a permanent capital loss rather than the short-term trading of a stock. I use 3 years as a period. I think it's a long enough period that, generally speaking, if you're right about a stock, 3 years should be long enough in most cases where that becomes apparent. It's not necessarily the case, but just as a rough metric, the way I think of risk is, okay, if I'm wrong over a 3-year period, if I'm not a forced seller, if I can sell at a time of my choosing, what is a reasonable price I could sell out at over a 3-year period? And I generally size the positions based on the downside, not the upside. I think that's important, particularly when you're running a concentrated portfolio. And I think that in addition to your sort of mathematical, what's my upside or downside valuation, I think there's certain qualities that are quite important to managing risk that I think are important to prioritize. So one of that would just be the balance sheet of the company. I tend to like companies with either net cash or a very small amount of debt. It would be quite rare for me to invest in a company with lots of debt. So I think that's one thing. Another thing is just the general quality of the business, but I'm more focused in terms of competitive advantages. If this is an advantaged company, during downturns, typically they would gain market share or they might benefit on a relative basis. And that makes things a lot more comfortable than if you're the disadvantaged player and you're sort of worrying about, do I go out of business during a downturn? Another thing in terms of the management, not just the quality of the management, but again, the integrity. I think low integrity management is always a big risk. And of course, finally, the last thing would be just the valuation. And I think if you combine these different factors, if you're buying businesses that generally have net cash or little debt, have competitive advantages, are run by high integrity people, and you're not paying a huge multiple of free cash flow up front, generally speaking, over time, the amount of money you can lose should be relatively limited. You might be wrong in terms of your upside. Maybe the management aren't quite as good as you thought. Maybe you didn't pay as cheap a price as you thought, but there generally shouldn't be that really substantial downside over a 3-year horizon.
Do you hold on to your winners?
It's a great question. Generally, yes, because these are companies that I think can keep deploying capital. And it always sort of surprises you when you review them a year, 2 years down the road, and you realize there's so much more upside than I thought because they've deployed all this extra capital. So generally speaking, yes. I will just caveat it by saying that I've always been someone who's cheap, essentially. You know, I really care about the multiple of free cash flow I'm paying. So that cheap gene is never going to leave me. So there are certain circumstances where I do reduce or sell out of a position. And that's probably always going to be the case for me. But generally speaking, yes, I'm trying to hold these businesses for many years.
I'll come back to the cheap gene. I have a question about that you might know that's coming. But I want to ask you about some common misconceptions about small caps. It's a certain universe. First of all, what is a small cap these days? How big is it?
Well, yes, it's a good question. I think the definition is sort of changing. I think most people would say under a $2 billion market cap. Some people have different criteria. Generally, for me, when I'm initially investing in a business, it has a market cap something like 300 to 700 million, and hopefully it grows beyond that. But I'm not sort of specifically wedded to those.
And talk to me about some misconceptions looking from the outside. And some people might shy away from the whole small cap category, especially value investing. It seems to come and go in favor. What are some of the misconceptions? What do we not understand about that space?
Yeah, I think that sometimes people look at small caps and think they're inherently more dangerous and more speculative. And I think that that's not inherently the case. I think that there is just a wider range of outcomes. When these are smaller businesses, they are going to be less developed and there are fewer investors looking at them. And so the companies that do well or the stocks that do well tend to do very well, and the stocks that do badly can do quite badly. But I don't think as an asset class overall, it's necessarily riskier. I just think it's an asset class that you have to do more work in, or you should do more work in, because there is that divergence in outcomes. Probably the other thing I would just distinguish with large caps is, I think Warren Buffett has talked about that when a great manager meets a bad business, it's usually the bad business that has its reputation still intact, and I think that's generally true. I would say that the smaller you go, the more of a difference the management team can make. Not necessarily in the case of a great management taking over a terrible business and really turning it around, but a great management can make a bigger difference, I think, in the small cap space, just because these are less developed markets. Unless it's a small cap competing against lots of bigger businesses in its industry. But if it's a small cap competing against other small caps, I think managements can make a bigger difference because there is a bigger difference in management quality.
I want to ask you about a certain phenomenon. So I've been investing professionally for a little over 20 years, and I'm watching the markets for a quarter of a century. When I started, there was private equity and there was venture capital, but it was different. And the big takeaway I have is that companies stay private longer. They have a longer runway. There's more capital available to them. And I think Facebook, no endorsement of any kind, was the first one that showed us that you could be a $50 billion market cap and still remain private until they eventually were listed. Do you think that made that universe of small caps different in some way, that those companies just don't have to go public for a longer period of time?
Yeah, I think it's probably the case, but I would say that there are still thousands of stocks in the small cap universe. I don't know the exact numbers, and I know it has declined, but there's still thousands of companies, and so there's still plenty of opportunities. And nowadays, I think more investors are willing to look outside the US as well and consider maybe other developed markets, some investors even some of the less developed markets. And so the total opportunity set, I think, is still very large. So I don't think that is a barrier, even though you're right. I think the number of companies has reduced.
I remember reading Peter Lynch's book, One Up on Wall Street, when I was a kid, and it just opened my eyes. But one of the things that I took away from that book is that you could find those companies before they are on every single shelf in every single store in the country. And you could take advantage of them and enjoy that ride for a longer period of time. Do you think that's what's happening with some of the small caps you're finding, that they have that incredible runway? Or is it more that it's an unrecognized value?
I think, that first criteria, those companies do exist, the ones that they're great businesses, they just haven't been discovered yet. There are some areas of small caps where your advantage is not necessarily that you've got some brilliant insight. It's just that there aren't that many people looking at these things. And so actually, in some cases, you don't even necessarily have to do really, really in-depth work with all the sleuth investing. Sometimes it is just that people aren't really aware of this and it's sort of hiding in plain sight. And then there is still that other category where you do get an advantage from doing more work. So I do think that that's the sort of flip side of the disadvantage of having to do more work, is that is kind of what creates the opportunity in some cases.
You could find something special. So let's talk about that cheap gene. And the reason I want to bring it up, and you know about it already, I'm not going to ask you about the stock you presented at ValueX. That's a secret. But I'm curious about the category, which I think we can say luxury goods one way or the other. The reason I want to bring it up, because as a fellow value investor, I have a hard time understanding why people would pay up for something that's just luxury. And I'll caveat that I understand quality. I have some things at home, including apparel, that I paid up for the quality, but not for the luxury. And I see the difference, right? They were not the cheapest thing on the shelf, but they will last the longest. And I have some items at home, including a raincoat that has been with me for 12 years, incredible brand, but I see the difference. Talk to me about that cheap gene. Talk to me about the challenge for value investors to consider luxury goods as a phenomenon. Why would people pay up?
Yes, well, I think it's I found it a very interesting industry to look into, because many of the businesses I look at are consumer businesses. I find it very fascinating that there are companies out there that sell products for thousands of dollars that only cost hundreds of dollars to make. And they're great products, but you're not really paying that price just because of the materials or the craftsmanship and so on. And some of these products, you're not even able to buy them if you want to buy them. You have to buy some other products that these companies sell. You have to prove your worth to the company, and you have to hope that at some stage they offer you the chance to buy not the product you really wanted, but something similar, and then you can buy that and then eventually work your way up. So I find that behavior really interesting as a consumer analyst. And the way I try to think about it is, what is the product really? It's not just the physical item. Generally, these companies are selling prestige or some type of status. And then that's very interesting, because can you really sell prestige and status, and how do you evaluate that? A lot of that is through heritage and history that takes decades and decades to build up. But I think a concept that value investors are probably familiar with that could be applied here is share of mind. So, we all know different brands in luxury, and there's a few of them that really have reached a point where just about everyone knows those brands. They sort of know what they stand for. And so the share of mind in the consumer is greater than even just the market share. And so I think it's just trying to figure out that share of mind. And if you can do that and find a luxury business that's really dominant in share of mind in its particular niche, I think that's how you can start rationalizing to yourself as a value investor, or with someone with a cheap gene, why people would buy these products. I would also say that just because the product itself may have reached that status does not mean you necessarily have to pay up for the stock. You can still be patient and wait until some of these stocks are at least relatively cheap, even though they're never probably going to sell at the same multiples as a storage tank business.
You say cheap gene. Let's call it a value quality gene as well. But when I'm thinking of acquiring any product, physical item, luxury good. I can't help it, but I'm immediately thinking, what's the cheapest item I can have in that category? To have the brand, but have it at the lowest price. And I can't help it. I think it's part of how I think about finding value in investing and finding value in life. But it doesn't necessarily mean it has to be the cheapest item on the shelf. I learned the hard way that the cheapest item will be with you for a short period of time. I have a pair of sunglasses that I paid up for, and they're very basic, but good quality. And I've had that pair for 10 years. I even jokingly told somebody on a sailing trip I dove for that pair that fell off my face into the water because I'm so attached to it. Yes. I've had many pairs since, most of them a lot cheaper, and they are no longer with me. So I think there's a lesson there. I have a draft of an article in my drawer that I'll publish at some point. I called it Invisible Wealth. And I want to bring it up because it bridges with what we talk about. A lot of the clients I work with, they're well-to-do, but you wouldn't be able to tell they're well-to-do. And I think it's a certain phenomenon. And it's not just first generation. It's maybe more so with inherited wealth. People are so comfortable with who they are, they don't have to show it. And maybe I'm stretching it a bit, but I think there's a certain phenomenon these days that it's this kind of luxury where you have a billionaire wearing a $40 watch and showing it off, or going on TV and driving a 20-year-old Toyota. I don't know how much of that is just PR. Mm-hmm. But I've seen actual billionaires wearing $40 watches in real life. So I think there's some truth to it. But I think there's a certain paradox with that whole category that some people respond to it, some people don't. And sometimes having that kind of invisible wealth, being at dinner and nobody knows that you're the richest person at this table, maybe 10 times richer than the second richest, and nobody knows that, and you can't tell based on what somebody's wearing. There's something powerful behind it. Do you have some thoughts on that?
Yeah, it's a very interesting point, and it goes to that comment about prestige. So I guess historically, prestige would be I'm wearing the most expensive clothes or the most famous brands, but that's really a cultural phenomenon. And what you're talking about is kind of another more modern cultural development, is that people are maybe pushing back against that a little bit. And I do think that for luxury companies, this is one of the risks, that actually it's great to have maximum share of mind, but you still want the actual product to be scarce. And so if you have you want a situation where everyone knows this brand, but not everyone owns the product or can own the product. And some of these luxury companies, I think, have greatly increased their production over the last decade. We've been in a period of very easy money. Financial assets have done well. People have used that wealth to buy many of these products. And you could argue it's a bit oversaturated. And there's a pushback against that as a result of that. And just more broadly in society, I think there's more of a counter-establishment culture right now. And so having that status be very obvious is also something that some people are pushing against. So I do think it's a fine balance, and scarcity, I think, is very important to any luxury product, and not taking that short-term gain of, we could increase production significantly and just make more money, and it's not really going to affect us for any, period of time. I think that's a danger for luxury companies. And if they overdo it and get rid of that scarcity, they can lose their prominence and prestige.
I find the whole phenomenon and category fascinating, and I'm not denying that, we all respond to it in many different ways. But since you brought it up during the conference, I wanted to ask your thoughts about it. Chris, I have one last big question. How do you think about success?
Yeah, I think, for me, I think a lot of investment managers, of course, they would say success is having good investment results over, whatever future period. And of course, that's part of it. But I think I would like to be not necessarily known, in the broader public, but just I would like to be able to confidently think of myself as an expert in the small cap space. If I could in 10 years be having this conversation and just be confident in myself that I've really studied many of these companies in the small cap space. If I'm didn't invest in them at the time, they went into my database, whether that's just a knowledge database or something more physical, and I really understand a lot of the small companies in all these different industries. I think that's, for me, what success would really look like. And obviously, I would hope that the returns and so on would follow from that. And I think another area of success, and partly why I launched my own fund and business, is just being your own boss and being able to spend your time looking at these things and directing your attention in that way, I think is really important to me. So just being able to continue to do that, I think would be success as well.
I'm hearing time luxury. You decide what you do, when you do, and who do you surround yourself with. Chris, this was such a wonderful conversation. I really appreciate you joining me for this 1 hour, and I highly recommend everybody to explore more the work that you do and your ideas and how you think about investing. And I learned a lot, and I appreciate your thoughts about investing in general, the cheap value quality gene that some of us have.
Yes.
And how we're handling this in the world with some luxury goods out there as well. Chris, thank you so much for today.
No, thank you so much for having me, and I was glad to be on.
You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil Baranowski.